So let's talk about cash value life insurance. Cash value life insurance is not term. It's just what it says. It has cash value. So in the policy, when you're paying your premiums, it basically imagine two buckets. This bucket is paying for the death benefit, the pure cost of insurance associated with if you pass away, how much it costs to insure that risk that the company's taken on you based on the death benefit. The $100,000, $200,000, $300,000, $400,000. The cost of that goes here. Some of the money though goes here, and that builds in some form of an investment for you. Normally, it's built around some type of index, like the S&P 500 index. So as the index goes up, you get some of the returns associated with the index. So it's a policy that builds cash through its performance of whatever index or investment you've chosen. Now, on the cash value policies, it's important to realize that on the investment piece of it, you're not going to get the full 100% return of, let's say, the S&P 500 index. You're going to get a portion of that, or your performance is going to be what we call capped at a certain rate. The cap rate is what the company allows you to make up to, so that you can get that type of performance credited into your policy. So if there's a cap rate of 12.5% and the market goes up 15%, you get 12.5. If the market goes up 10, you get 10. So you get all the performance up to 12.5, you don't get any more than that. One of the misnomers is that everybody thinks, oh, all the excess return is being made by the insurance company and it's going in their coffers. That's not true. Basically, the insurance company is buying contracts every month or over periods that allows them to lock in returns. If the contracts are in the money, you make money. If they expire worthless, that's it. The insurance company isn't making all this extra cash. So under the cash value life insurance, the idea is that over the long term, as you're paying your premiums, you're building some money in an investment account for you. It's slow. It takes time. One of the things about cash value life insurance is initially there are commissions to the broker. There's expenses associated with the policies. So normally you have to recover those things, and that usually happens in about the first 10 to 15 years. But the nice thing is as that cash value builds for you, the insurance is permanent. When you're buying cash value life insurance, you're buying insurance that will essentially be there till the day you die. It's permanent. Or be there to build money for you that you can use additionally in retirement or for an emergency. And because it's in a life insurance wrapper, there's a tax loophole that allows all that money to be able to grow tax-free. You essentially can borrow that money out, and it's a tax-free event because it's considered to be borrowing. It's not considered to be liquidating the policy, so therefore the government allows you to have some nice tax benefits by doing that. So with that cash value, you can use it for a variety of different expenses, and it slowly builds over the life of the policy. Cash value life insurance, as far as its cash accumulation portion, is really a long-term investment. You're putting it in there for 10, 15, 20, 30 years. But what happens with a lot of these policies is it builds cash. That cash, as it builds, pays crediting. It has interest that can be used to offset the cost of the insurance along the way. So many people might pay into their policy 5, 10, 15 years and simply not pay anymore because there's enough money in the policy to keep paying those costs of insurance. So it becomes a way effectively for people to have permanent insurance and not necessarily have to make payments for the rest of their life like a term policy might have. With term, you're going to have to make those payments for 10, 20, 30 years. It's just a piece to the overall portfolio. So I've often told people, if you want insurance for a long period of time and you want to have some return on that money as you're putting it in there, cash value becomes a very nice alternative. It's not going to hit the home run. It's not designed to do that, but it will give you some participation up to a certain level of that cap rate. The nice thing is because you don't have 100% of the upside, you never get any of the downside on that money, meaning that if the market goes down 5, 10, 15, 20%. You're going to get 0. So you're in the ball game when things are going up. You're out of the ball game when things are going down. It's kind of like a stair step. So I think when I'm talking with clients, normally there's probably a need for both, having some term and having some permanent insurance. But it's very important that you understand the commitment of what you're making with the permanent, because it is a longer term strategy, and also that you realize that with that cost of a permanent insurance, it's going to be more expensive initially. They're driving higher premiums because they want to have a certain amount of money every month or every year or every premium payment going into that investment account to help build some long-term cash for you.